How about my third bullet point? Well, my third bullet point, I slipped that in because in the coalition government's document, they said in one of their, we will do this, we will do that, one of their we wills was, we will review the IR35 legislation. What the hell is the IR35 legislation, you shout? It was introduced in the year 2000, and it is the legislation which tries to clobber people who use personal service companies. That's talking technically. It does this by making people who operate through a personal service company take out their income by salary subject to PAYE and national insurance contributions, and if they don't, they're deemed to do it anyway. I hoped that in this budget we would hear a bit more about that. I have been sadly disappointed, but it is in their policy. They obviously want to do this. I assume that what they're going to do is to relieve the rules in some way. I might be wrong in that regard. Their review of it might be to make them even more spiteful than they are at the moment, I suppose, but I don't think so. So I think that's a watch this space, but if it is possible more readily to use personal service company structures, that will open the door for people to operate very much more tax efficiently with companies by accumulating profits at much lower rates, or simply getting income into a company and out without triggering national insurance contributions. So watch that space. There's the first four. Four more. Right, still no national insurance on dividends. National insurance we looked at, it's gone very, very high. What can we do about that? The obvious way, I've just said, use a company structure and get out by way of dividend. You pay tax at a lower rate and then you don't pay national insurance on the way out. Can this survive much longer? Well, it's survived for donkey's years so far. If you compare and contrast a nurse, let's say, a nurse working at, let's make it as extreme as we can, a nurse working at Great Ormond Street Hospital for Sick Children, who earns £25,000 a year, let us say. What is her marginal tax rate? If she gets a salary rise of £1 or £100, let's say, how much tax and national insurance does she pay? Answer, 31%, because she's a 20% taxpayer and an 11% national insurance payer. But from next year, 12%, so it's going to be 32%. And her employer has to pay 12.8 currently, 13.8 from next year national insurance on that increase. So that's quite a lot, isn't it? 32 plus sort of 13.8 gets north of 45%. So look at her, then look at somebody who is rich, someone who has a trust fund. Yes, let's think about someone with a trust fund who swans around Chelsea, bars in Chelsea, or the fifth floor of Harvey Nicks, using money that daddy has provided, and it comes out as investment income, and she gets about 40 grand a year and fritters it away, but she's only a basic rate taxpayer. How much national insurance does she pay? None at all. Why not? Because there's no national insurance on investment income. I could put together a very persuasive political case for changing that in some way. Whether it be national insurance contributions, I don't know. I might go back to investment income surcharge. That would do the trick nicely. We used to have that before, and when we had investment income surcharge, dividends didn't work. And it was only the abolition of investment income surcharge that made dividends attractive for this purpose. So, next point, very easy point. If we've got the 50% rate of tax, how can you avoid it? You spread income. That's what you do. You spread it as wide and as thin as you can. It doesn't have to be that thin. 149,999 will do nicely, but if you spread it amongst enough people, you will avoid the very high rates of tax. We used to do it to try to avoid the 40% band. Now the name of the game is doing it to avoid the next step up. Remuneration trusts, I've already alluded to. I've already alluded to remuneration trusts. The law is going to be changed, but it isn't being changed yet. The subtext there is keep going until they change the law. Final point on that slide, use of company purchase own shares to extract value. I mean, this is a very, very straightforward point. People The commentators make out it's really easy to convert income into capital. Rich people, oh, they don't pay any income tax, they only pay capital gains tax, and it's only at a speck, it's an outrage, because they turn all their income into capital, job done. And it is actually hugely difficult to do that. If you are in the world of private equity, it is probably easier generally, it is possible, but usually it's hugely difficult. But a very easy example, if you were coming up to retirement, and you had your shares in your company, and you typically drew out income by way of dividend, but you didn't really need the income. It's a no-brainer, isn't it? You just leave it in the company. You leave it to accumulate. You pay your tax in the company at maybe 20% now. And what do you do then? You get the company to buy in your shares. You need to get a revenue clearance for this. You need to have a commercial justification for this, but that isn't very difficult. And you then get your money out paying tax at only 10% because you should qualify for entrepreneur relief. Very simple point, very, very simple point, but worth thinking about. And finally, the rules regarding business assets for CGT purposes. Well, what have we got? We've got entrepreneur relief. The name of the game is qualify for entrepreneur relief. That is what you've got to do. And there are some pitfalls there, but there are some opportunities. So quick pitfalls, you've got to be a worker, but you don't have to do anything. Is that not something of a misnomer, a worker who does nothing? Could be a politician, perhaps, no. So being an officer of the company is good enough. You can be a non-executive director, you can be a secretary of the company. That is good enough. You don't have to do any work. There is no number of hours requirement, none at all. You have to have the right number of shares, at least 5%. If you've got 4%, it's no good to you. You've got to have 5%. Thereafter, you've got to have a trading company. So if you've got a company that isn't doing a trading activity, there's no good trade, bad trade rules. You can have a company that trades in the most heinous thing. It could be dealing in, I don't know, dealing in arms, dealing in goods. It could be a dealing company. It will qualify. But the real planning point is this. If you only need 5% and you have a £5 million limit, if there's one of you, you're going to get one £5 million. But if you're a husband and wife, it's easy, is it not, to get two £5 million? All you've got to do is transfer some shares to your wife. She's got to own them for a year, so you can't do it in the teeth of a sale. So you've got to do a little bit of pre-sale planning, but you do it a year before. You make her an officer. You're home and dry. If you've got kids, if you've got children who you can make directors, they don't have to work in the business. You'd have to get the shares to them, but if you've got a trading company, you should be able to transfer the shares to them and claim business asset holdover relief. It won't be hard to do. So you can look at your family, and if you do it right, if you're going to sell your company for, let's say, £20 million, you should be able to ensure that it's all taxed at 10%.